financial statements analysis or the ratio analysis. When this question is going to be tested in your exams, if it comes in your exams, it is going to be a simple one. This one being, the examiner will prepare for you the income statement and also prepare for you the statement of financial position. And then from those statements now, you are required to calculate the ratios. So what is important to you is to know the formulas for these ratios. So if you are told to calculate a particular ratio, you need to know how do you calculate it. The moment you know the formula, the figures that you are going to feed into the formula, you are going to get them from the statements that have already been prepared for you. So it is going to be a very, very easy task for you, but you must be able to understand the formula for the ratios that you are supposed to calculate. So I'm going to take you through those ratios that are commonly tested. We have quite a number. There are quite a number of ratios, but we have those ratios that are commonly tested. Those that are commonly going to appear in your exams, I'm going to take you through them and also make you understand how do you calculate them if they happen to come in your exams. So that is going to be actually the topic of today. So I want to share the notes, that is the PDF notes. And then from the PDF notes, I can be able to take you through what is ratio analysis, the different categories of ratio analysis, and how to calculate them. And then later on, we can now integrate what I'm going to teach you, all the formulas, and apply them in calculating some ratios from the past paper questions. So I will take you through the PDF notes first. So this is accounting and financial management. I understand that this is the introduction to financial accounting, but you are going to use, this topic is appearing to both you, the old curriculum, and also the new curriculum. So don't actually be worried that you are CHRP 04, but understand that the concept is the same. So the financial statement analysis and interpretation, also known as the ratio analysis. So a ratio, or first of all, the financial analysis is the process of critically examining in details the accounting information given in the financial statements and the reports. Once the financial statements have been prepared, you need to have a critical examination about those particular financial statements so that you can be able to get actually the true and correct picture about the financial performance and the financial position of the firm. So that is actually what we are going to do. And when we say ratio, a ratio, we must have it in form of a fraction. So there must be a numerator and a denominator. And some of them, we are going to actually make them into percentage. So there is a figure that we are going to use as a numerator, divided by another figure which will appear as your denominator. For some ratios, that is enough. For others, then you convert whatever you have calculated or divided into percentage. So that is it. Let me take you through the objectives of financial statements analysis. Why do we need to do the financial statement analysis? Why do we need to calculate the ratio? That, number one, we have to assess the past, present, and future performance of an enterprise through the ratios. Some of the ratios we normally use the current value divided by the previous value, and then you can be able to get the trend about the business. Number two, to assess the operational efficiency of the firm as a whole, or the performance of different departments within the organization. So you can be able to know maybe in terms of profitability, Department A realized a profit of 40%, Department B realized a profit of 25%, and therefore you can be able to rank the departments depending on how they perform. Number C is to assess the short-term and long-term solvency of the firm. We normally say that the short-term ability of the firm to pay the short-term liabilities, we normally call it the liquidity, and then the long-term, we normally call it the solvency. Through ratios, we can be able to assess whether the business is able to pay the short-term debts and also the long-term debts of the firm. Number D is to use to assess the performance of the firm against others in the same industry against others in the same industry. Just a minute. In the same industry. And to assist in developing forecasts, you can be able to know, maybe last year we made a profit of 10%. This year we have made a profit of 20%. You can be able to predict what might happen in the future and therefore prepare the appropriate budgets. Because you can be able to know that maybe the sales are increasing, so you can make a very good budget in terms of the quantity of goods that you intend to purchase in the next financial period and so on. Then to assess the financial stability of the business and also understanding the real meaning and significance of the financial information. So when you get the information in form of statements, you might not get the critical meaning. But when you calculate the ratios, the profitability ratios, the liquidity ratios, and all that, they give you a better understanding about what those ratios mean or the performance of the business. Classification of ratios, we actually have 4 categories of ratios, but in your case, you normally deal with the first 4. The first 4, the profitability ratios. These are ratios that we normally use to compute the profit position of the business. We normally use them to calculate the profit position of the business. They are known as profitability ratios. So under profitability ratios, we have quite a number of them. We shall actually see how we calculate them. Then we have category number 2, the liquidity ratios. These are ratios that show the ability of the firm to pay short-term liabilities. The ability. If you as an individual, you can actually evaluate yourself. How able are you to pay the short-term liabilities? Those liabilities that are supposed to be payable within a short period of time. So those ratios that we normally use to calculate the ability of the business to pay the short-term liabilities, we normally refer to them as liquidity ratios. When a firm is liquid, it has enough cash. When the firm has enough cash, it simply means that when any liability will be due for payment, the firm will also be in a position to pay because you have the cash in hand or the cash at the bank, or you have got the short-term, the assets that can easily be converted into cash to pay those particular debts when they fall due. So the liquidity ratios. And here, remember, short-term liabilities are paid using the current assets. So here it's like we are measuring the amount of current assets that we have versus the amount of current liabilities that we owe the others. So are the current assets enough to pay the current liabilities? So that is what we are trying to evaluate. Then we have the efficiency, activity, or turnover ratios. These are ratios that we normally use to evaluate how well an organization is utilizing the assets to generate revenue. We have got assets worth a certain amount of money. Are we utilizing these assets effectively and efficiently so that we can be able to realize profit? So activity ratios or efficiency, how well we are using the assets that we own in generating the revenue. If we have got a lot of assets, but the revenue is very small, then it simply means that we are not utilizing our assets properly. Some of our assets or a lot of our assets are just sorry for that. I was explaining about the ratios number 3, the efficiency or activity ratios, which are used to measure how well the organization is using its assets to generate revenue. So if the revenue is very, very low compared to the value of assets that we have, we can actually be able to know that we are not utilizing our assets efficiently in generating revenue. If the revenue is high compared to the assets that we have, then we can say that we are effectively and efficiently using our assets in generating the revenue. Then we also have the ratios we categorize as the capital structure, leverage, or gearing ratios. The ratios, they measure the proportion of debt and equity capital in the business. So the capital that you have in your business, part of it we normally call it equity, part of it we normally call it debt. The equity is what the owners have contributed, while the debt is what we have borrowed. So it is like we are measuring the capital that we have, the proportion that is for or belongs to the owners, and the proportion that is borrowed. So that is what we call the leverage or the gearing ratios. And actually these ratios will tell us the ability of the firm to operate even in the long term. You should not have a lot of debt at the same time. Just a minute. Yes. Okay. Sorry for that. I was attending to someone. So we have now the profitability ratios. We have said that these are ratios that measure the performance of the firm in terms of profit that has been generated from the operations. So these ratios, they are number one, we have the return on capital employed, which we normally denote as the ROCE, which is the net profit after tax divided by the capital employed. How do you get these figures? Capital employed, you take the total assets, you minus the current liabilities. Remember, total assets, it is a fixed assets plus current assets. The fixed assets plus current assets, they give you the total assets. Then you minus the current liabilities, they give you what we call the capital employed. Or the capital employed can also be the share capital plus the reserves plus the long-term debt. This is the share capital, the capital that was raised from the selling of the shares. Reserves are the same as the retained earnings, and then the long-term debt. The long-term debt, they include things like the debenture and also the long-term bank loan, and also the long-term bank loan. So you are told here, the higher the ratio, the better the performance of the firm. So note this, the key thing is to understand how do you get capital employed? Total assets minus current liabilities. So you take all the fixed assets plus all the current assets, they give you the total assets, you minus the current liabilities. The current liabilities are things like the trade payables on the creditors, the things like the bank overdraft, and also the accrued expenses. You minus all of them, you get the capital employed. Then you divide that using the figure of the net profit after tax, also known as the operating profit. Then we have got the net profit margin. Simply take the net profit for the year, you divide by sales, you make it a percentage, you multiply by 100%. You multiply by 100%. We also have the gross profit margin. The gross profit divided by sales. Always remember, how do we get the gross profit? Gross profit is given by opening stock, sorry, the sales minus cost of sales. Gross profit is sales minus cost of sales, where cost of sales is opening stock plus purchases minus closing stock. So this one will require you now to remember what you said about the financial statements, both the income statement and the statement of financial position. Gross profit. The good thing, you'll be given these figures in the statement, so you just pick them. Then we have the return on equity, the profit attributable to equity shareholders divided by the net worth or the equity. This, you need to understand it, but though it is not commonly tested, but understand it is the profit attributable to equity shareholders, what they are supposed to share as dividends. Then you divide by equity. And here you are told that equity is going to be equal to share capital. It is going to be equal to share capital. Just a minute. So equity, share capital, plus the share premium, plus the reserves, plus the retained earnings. This one you can relate from what we discussed about the company accounts. The equity is the share capital, share premium, reserves, and retained earnings. All of them, you add them, you get the equity or the net worth. Then you divide by the amount that the owners are supposed to get as the dividends. You get that as your return on equity. Then that is number one, profitability ratios. Number two is the liquidity ratios. Liquidity ratios, you need to understand two of them. There are actually two which are most commonly tested, the current ratio and the acid test ratio. The current ratio, it is simply the total current assets divided by the total current liabilities. You just get their totals, then you divide them, you get the current ratio. Amount of current assets that we have divided by the amount of current liabilities. In short, we are asking ourselves, the current assets that we own, are they enough in terms of value to pay the value of current liabilities, which are the debts that we owe, and they are the short-term debts. So, and here you are told the ideal or the best current ratio is normally 2:1. So it simply means that for every 2 units of current assets, they should pay 1 unit of current liability. So if you have got 2 shillings worth of current assets, then you should have 1 shilling worth of current liabilities to pay, so that at least you remain with 1 shilling. So that is what we mean. Then we have the quick ratio or the acid test ratio. These are very commonly tested. Very commonly tested. The quick ratio or acid test ratio, it is a modification of this current ratio. They normally argue that this item we call inventory, yes, it is categorized as a current asset. It is categorized as a current asset. But they argue that some inventory items might not be current asset. The key definition of a current asset, it is something that the business owns, something that we own as a business, but that resource will not be in the business for more than 1 year. So in those 12 months that we normally operate what we call the trading period, that resource will not be there for more than that 12 period duration. Then it is a current asset. Something that can easily be converted into cash, it is a current asset, including cash itself. So they argue that you will have some inventory items that can stay as inventory for more than a year. Therefore, they don't qualify to be called current assets. So for the quick ratio, we subtract the figure for the inventory from the current assets to get the real current assets, those that are going to be in the business for less than a year. Then we divide by the current liabilities. So it is actually the current ratio, but in the current assets, we minus or deduct the inventory value, and then we divide that. The ideal ratio here is 1:1. 1:1. Then we also have the cash ratio. Cash ratio, it is rarely tested, but remember it is normally cash. And here cash will mean cash in hand and cash at bank, together with the cash equivalents. Cash equivalents are those items that can easily be converted into cash, including things like the treasury bills and all that. And then you divide it by the current liabilities. So you can be able to see that the three of them, all of them, the denominator is the current liabilities. All of them, the denominator is the current liability. For the current ratio, current assets divided by current liabilities. For the quick ratios, current assets minus inventory, but divided by current liabilities. And then the cash ratio is the cash. In most cases, you will be given the cash in hand and the cash at the bank. Add them, you get the cash, but you divide it with the current liabilities. We said that these are the liquidity ratios. They measure the ability of the firm to pay current liabilities using the current assets that we have. Those are the category number 2 activity ratios. Sorry, liquidity ratios. Then we have these ratios we refer as the turnover ratios. For turnover ratios, I want you to take keen note of the following. Number 1 is the stock turnover ratio. Remember we said that These are ratios that measure how well the farm is utilizing the resources in generating revenue. So we have the stock turnover ratio or inventory turnover. They measure the number of times the inventory is converted into sales or into cash. How well are we converting inventory into sales? In simple terms, how many times are you restocking your business? The number of times you are restocking your business is the same as the stock turnover ratio. The rate at which you are restocking your business is the same as the rate at which you are converting your stock into sales. The higher the rate, the better. The greater the number of times you are converting stock into sales, the better the performance of the business. And it is given by the cost of sales divided by average inventory. Cost of sales, don't ever forget, it is opening stock or opening inventory plus the purchases minus the closing inventory. So you take them, then you get the figure. In some questions, they will be given or you will be given the cost of sales. But in other questions, you can be given the opening stock separate, the purchases separate, and then the closing inventory separate. You need now to understand, if you are given the three of them, how do you come up with the cost of sales? Take the opening stock, add the purchases, minus the closing inventory. You get the closing, the cost of sales. Then you do the average inventory, which is given here. You add the opening inventory plus the closing inventory. You divide by 2. You divide by 2. You get the average inventory. Stock conversion period, you do the reciprocal of this. Instead of cost of sales over average inventory, now do average inventory divided by cost of sales. But because you are talking about period, you multiply by the number of days or months the business is operating in a year. Number of days, it can be weeks, it can be months, your business is operating in a year. We know in a year we have got 365 days, but most businesses, they don't operate the full 365. You can be told that the business operates for 340 days in a year. So you multiply by 340. We know we have got 52 weeks in a year. You can be told that the business operates for 47 weeks in a year. You multiply by 47, depending on what you are given. But if you are not given any, you are not given the days the business operates in a year, you are not given the weeks or months it operates in a year, you multiply by 365. You assume it was operating a full year period. So then we have the debtors, receivables, turnover. Debtors, remember, it is the other name for the accounts receivable. And actually, the accounts receivable, it is now the commonly used term. So the debtors turnover, it is the number of times debtors are converted into cash. Debtors are the customers who bought goods on credit from your business. How many times are we converting that money into cash, into real cash? Or how many times are we converting or collecting that money from them and then bringing them into the business as cash? So the frequency of receiving payments from the debtors, the higher the frequency, the better the business. We normally take it to be credit sales over debtors or credit sales over average debtors. So average debtors is going to be applicable when you are given the opening balance for the debtors and the closing balance. But if you are only given the debtors figure without the opening and the closing, you use that figure here. You use that figure the way it is. Then we have the debtors correction period. The debtors correction period, the number of times or days or weeks or months the firm will take to collect money from its customer. The shorter the period, the better. The shorter the period, the better. It is the reciprocal of this, but you multiply by the days. Here it is credit sales over average debtors. Here it is going to be average debtors over credit sales, but now you multiply by the days, weeks, or months. Let us do this and then we do a question. This is the creditors or the payables turnover. The creditors or the payables are your suppliers from whom you bought goods on credit. So what does it mean? What does it mean? It is the number of times we are making payments to our suppliers. The number of times we are making payments to our suppliers. So because we are paying, we are told here that it is a cash management strategy to delay payment as much as possible and collect money from debtors as soon as possible. So because we are paying them, the longer the period it takes for us to pay them, the better for us. Because that money, when we delay paying them, we are utilizing it to actually get some income from it. So the longer or the shorter or the less the number of times, the better to the business. If you have got the creditors or suppliers and they give you a long period of time before you pay them, the better to you, because that money that you could have paid them now and they require it now after 1 month, after that 1 month, you can use that money to generate more revenue. So the longer the period or the more number, the shorter the number of times that you are paying them, the better to you. It is like the opposite of the receivables turnover. The receivables, because you are correcting, the more number of times you are correcting, the better. But here now, because you are paying, the fewer the number of times you are paying them, the better to you, because you are going to remain with that money for a longer period of time. When you have it, you can use the same money to generate more revenue before you issue it to the creditors. And here you are told that the creditors or the payables turnover, it is the credit purchases divided by the average creditors, or simply purchases over the creditors. And then the average creditors, if you are given the opening and closing, you add them and divide by 2. But if you are only given one figure for the creditors, you use that figure without averaging. Then we also have the creditors payment period, which is the number of days or weeks the firm will take to make payments to the suppliers. So firms should delay in paying suppliers. Thus, the longer the credit period, the better the firm. I think that one I've said, and it is like the reciprocal of this, but you multiply by the days, weeks, or months. So you, instead of credit purchases of other creditors, you do now average creditors over purchases. That is what, but remember to multiply by the days. Then we also have the fixed assets turnover. You do turnover. Turnover is the same as sales, and it is the same as revenue. You take the sales over fixed assets, you get the fixed assets turnover. Total assets turnover, you simply take the fixed assets plus the current assets to get the total assets. So because it is total assets, it is going to be sales over total assets. And the current assets turnover, it is sales divided by the current assets. Lastly, we have the gearing of the leverage ratio, also known as the capital structure ratios. They show the proportion of debt and equity in financing the firm's assets or capital. The capital that you have, which proportion is debt and which is equity. Equity is what has been invested by the owners, and debt is what you have borrowed. So in simple terms, it shows the proportion of capital that is borrowed and what has been invested by the owners. So here we have the following. We have the gearing ratio or the debt to equity ratio. Take the fixed return capital. Fixed return capital, it is the borrowed capital that has got a fixed rate of return. Here we have things like the bank loan. We have things like the debenture. We have the bonds. That's why we are adding them here. The fixed return capital, it is the debenture. They normally come with a fixed percentage rate of return. That's why we have 10% debenture, 12% debenture, and all that. The same case applies to the bond. 80% bond, 5% loan, 12% preference shares. So these ones, they have the fixed return. So we add the amount that we raised from each of them. We get the fixed return capital. Then we divide by equity capital. Equity capital, once again, it is the share capital plus share premium plus reserves plus retained earnings. All of these, it is the amount of money in form of capital that belongs to the shareholders. So we get what belongs to the shareholders, but the numerator will be what we have borrowed in form of a fixed return capital. Debt ratio, simply take total liabilities over total assets, both long-term and current liabilities, and then you divide by the total assets, both fixed and current. Then we also have what we refer here as the equity ratio. Take the equity using the formula that we have here, divided by the capital employed. Again, don't forget, capital employed, we said it is total assets minus current liabilities. You get that. You get that. So those are the commonly used. I don't want to take you through these others. I don't want to take you through these others, but understand also the advantages and the importance of the ratio analysis. Why do we require the firm to do ratio analysis? Of what importance? You have this. It evaluates or determines the firm's ability to meet short-term financial obligations when they fall due. That is through the calculation of the liquidity ratios. They also show the extent to which the firm uses its assets to generate sales and profit, that is activity and profitability ratios. They determine the extent to which the firm is financed by non-owner fund, the debt. That is through the calculation of the leverage or the capital structure ratios. To compare the firm's performance with other firms in the same industry, what we call the cross-sectional. If you are a three-star hotel, you compare your performance with another three-star hotel by comparing your ratios. The performance of the firm over time, that is intra. You compare within yourself. This year we made a profit of 10%. Last year it was 15%, so we have declined. So you are comparing within yourself, intra firm. It provides the greater clarity and the deep understanding of the information in the financial statements. Once you calculate the ratios, you get a deeper understanding on what those profit figures mean. Helps in formulating financial policies, and also it is effective cost control measure. Limitations or disadvantages. Sometimes you can calculate ratios using incorrect accounting data. If their financial statements are long, then it simply means that even your ratios are going to be wrong. So that is one of the limitations. Price changes. Changes in price make comparison in various years difficult. Like, for example, you can find that last year, the cost of items were very cheap, but this year, the cost of items are gone high. So comparing the performance between the 2 years becomes a challenge as a result of the price level changes. Then the other disadvantage or limitation it ignores qualitative factors. Ratios, we only use the figures. We only use numbers. What about these attributes that cannot be expressed in terms of numeric? The things here, like maybe the motivation and all that. We cannot actually quantify motivation. Therefore, we cannot use motivation in calculating the ratios. So it ignores the qualitative aspects, yet some of them are very important. Historical data. Ratios are calculated using data that from outdated or the previous data. Remember, we calculate ratios at the end of the financial year using the data that has occurred in that year. So if we are calculating the ratios in that 1st December, that is data that has occurred this year from January. So it is normally historical, and you might find that what has happened might not be important in predicting what might happen in the future. Different accounting policies. Some firms have got different accounting policies. Therefore, it becomes a bit difficult to compare the ratios between those firms. And also, it is difficult to decide on the proper basis of comparison and use of different accounting methods, and also the periods. You might find that we calculate or we prepare the financial statements after 10 months. You prepare after 12 months. It might be a bit tricky. Ratios are insufficient in themselves as a basis of judgment about the future. So there must be a human element. You cannot use the ratios alone. So that is it about the theory part of these ratios. This document is with you. You can go through it on the theory part as I take you through the calculations. So let me share the past paper questions. So these are the revision questions that have been tested in your exams. I don't know which year was this, but the following information was extracted from the books of Zabaleta. And here you are told for each business, you determine the rate of stock turnover and the current ratio. Remember here now, how do we calculate the rate of stock turnover? It is the cost of sales divided by the average stock. Divided by the average stock. So we have got two businesses, Zabaleta and Zioneta. So for Zabaleta, you calculate the cost of sales. You take the opening stock, you add the purchases. The opening stock, it is 400,000. You add 750,000, which is for purchases. You rest the closing stock, which is 600,000. You will get the cost of sales. Then you divide by the average stock, which we said it is opening stock plus closing stock divided by 2. So you take 400,000 divided by 600 divided by 2, you get the average stock. So the figure for the cost of sales that you got divided by the average stock that you got, it gives you the cost of sales for, it gives you, sorry, the rate of stock turnover for Zabaleta. For Zioneta, you do the same. You take the cost of sales, the opening stock, 600,000, add the purchases, 1 million, then you deduct closing inventory, 400,000. It gives you the cost of sales. On another point, you calculate the average inventory. Opening stock is 600,000 plus the closing inventory, 400,000. That is 1 million divided by 2. Average stock is 500,000. Take the figure for the cost of sales, divide by the figure for the average inventory, you get the cost of sales for Zioneta. So you get the stock turnover ratio for Zioneta. So that is all. The current ratio, current assets divided by current liabilities. So you need to come here and understand what are my current assets for Zabaleta. Zabaleta, the current assets, always remember here we are doing for the year ending at 1st December. The current asset here is the closing stock, not the opening stock. Opening is what we had at the start, but the asset is what is still in the business, and that is why we use the closing. So you take the closing stock, which is an asset, add the data, it is a current asset, add the bank, it is a current asset. Those three, they will give you the total current assets. Divide by current liabilities. Current liability is only the creditors. It is only the creditors. So you are done. So this is how you are going to do that. So for that question, you need to understand two things, and I've repeated here, the cost of sales. It is given by the opening inventory plus the purchases minus the closing inventory. That one will never change. You need to understand that is the formula for getting the cost of sales. So here, we also know how to get the average. Actually, it is the opening inventory plus the closing inventory divided by 2. Then you need to also now to remember how do we calculate the stock turnover. The cost of sales divided by the average inventory. So you need to calculate for Zabareta. The COS, cost of sales, you take the opening inventory for Zabareta. The opening inventory for Zabareta, which is 400,000. Add the purchases, which is 750,000. Minus the closing inventory. The closing inventory is 600,000. So that one will give you 550,000. Calculate the average inventory. Opening stock, which is 400,000, plus the closing inventory, which is 600,000, divided by 2, which is 500,000. So what is the rate of stock turnover? The rate of stock turnover is the cost of sales of an average inventory. Cost of sales is by 50,000 divided by 500,000. So you take the cost of sales figure divided by the average inventory figure. That one will give you the answer. By 50,000 divided by 500,000 gives you 1.1. Right there, 1.1 times the number of times we are replacing or replenishing our inventory in a year. It is 1.1 times. That is the answer for Zabareta. You come here and also do for Zionita. Zionita, you calculate the COS. The opening stock is 600,000 plus the purchases, which is 1 million, minus the closing inventory 600,000. That one will give you 600. That one will give you 1 million. That one will give you 1 million. Average inventory. Take the opening plus the closing. Sorry. What have I done here? The closing for your meter is 400,000. It's 400,000. So this one is going to be 1,200,000. That is it. 1,200,000. For the average inventory, you take the opening inventory plus the closing divided by 2. That is 600,000 plus 400,000. That is 1 million. You divide by 2. This is going to be 500,000. That is 500,000. So to get inventory turnover, to get the cost of sales, 1,200,000 divided by the average inventory 500,000. How many times are we converting our inventory into sales? 2.4 times. That is all about part 1. That is all about part 1. Just that. Understand how to get cost of sales, understand how to get the average. It's all. Current ratio, current assets over current liabilities. Again, here you need to understand what constitutes current assets. What are the items that qualify to be called current assets? Current assets comprises of inventory, debtors or accounts receivables, cash in hand, cash at bank, and also the prepaid expenses. All those are current assets. So when they are given separately, you should be in a position of identifying them, and then you sum them, the figures to get to the total current assets. What constitutes current liabilities? We have the payables, also known as the creditors. We also have the bank overdraft. We also have the accrued expenses. Accrued expenses not yet paid by the end of the year. All those are current liabilities. So you sort them out from the figures that were given, you add them, you get to the total current assets, then you divide the two figures. So in this question, current ratio equals current assets or Zabareta. The current assets is divided by current liabilities. So you can be able to tell that the current assets for Zabareta is closing inventory, 600,000, plus the debtors, 700,000, plus bank, 300,000. So the current assets is 1,600,000. Total current assets, 1,600,000 for Zabareta. Current liabilities, it is only the creditors. Remember that sales is not a liability, purchases is not a liability or an asset. You need to note that. Then, what is going to be the current ratio for Zabareta? Take the current assets, 1,600,000 divided by 200,000. That is going to give you 8. Put there 8 is 1. The current ratio and the asset test ratios, you put them into ratios. The turnovers, the stock turnover, the asset turnover, any turnover ratio, the answer you get, you write times, the number of times. But this is a ratio. The answer you get it is 8, but you put it in ratio form, 8 is to 1. You do the same way with the Zioneta. For Zioneta, current assets, closing inventory, 400,000, plus the debtors, 800,000, plus the cash at bank, 500,000. This one will give you 1,700,000. Current liabilities, the payables or the creditors, 400,000. So the current ratio is going to be current assets over current liability, 5, 4.25. Sorry, 4.25 is to 1. That is all about that question. So can you look at the second question? You tell me whether you can attempt. Let us try the second question so that I can leave you with the third question. Sorry for that. So this is a bit comprehensive. You can be able to see here, this is the trial balance. Actually, this is the income statement. I told you that you will be given a summarized income statement and sometimes also with the statement of financial position. So on the other side, you are given the statement of financial position. So they will be prepared for you. Your work is simply now to lift the figures, only if you understand the formulas. So here, number one, it is about the current ratio. Current ratio, we have agreed that it is current assets over current liabilities. So you need to come here. This is 2 years, the year that ended 2015 and the year that ended 2016. And here you are told compute the following ratios. And actually you are supposed to do it for each year. So you need to calculate the current ratio for the year ended 2015 and the current ratio for the year ended 2016. From what we know, current ratio, it is the current assets divided by the current liabilities. So for 2015, the current assets, it is 78 plus 60. That is the inventory plus the receivables. Receivables are the same as the debtors. So you get what, a figure of 138,000. So you take 138,000 and divide by the figure for the current liabilities. The current liabilities is the trade payables, the proposed dividends, and the bank balance. The three of them, if you add these three, they give you 100,000, 800,000. So the current ratio for the year ended 2015, it is 138,000 divided by 100,800. So like that. So don't take for 11. For 11, it is the sum of the current assets and the non-current assets. If you take 273,600 and 138,000, that is where they are getting this for 11,600. So you only take for the current asset, 78 plus 60, 138,000 divided by 100,800. You just divide, you get the answer, and the answer you get, you put is to 1. For 2016, you do the same. The current asset is 114,000 divided by the current liability is 75,000. The answer you get after dividing, you put it is to 1. That is all about Roman 1. Hope you have done that. Column 2, the quick ratio. The quick ratio, remember we said it is the modification of the current ratio. It is the modification of the current ratio. The quick ratio take the current assets, then you deduct the inventory or the stock. And I've told you the reason why we deduct the inventory is that some inventory items, they overstay in the business, and therefore we disqualify them from being current assets. So we remove them from the current assets. Whatever we get after subtracting it, we divide by the current liabilities. For this year 2015, that ratio could have been, you just go straight to your, let me use on the current assets for 2015, they were 138,000 minus the inventory, which is 78,000, divided by the current liabilities in that year, which were 100,800. 8,000 minus 78,000. Get that. Then you divide by this is 0.6. That's that. You go for 2015, the current ratio, the quick ratio rather, the current assets. For that year, we were amounting to 114 minus the inventory for that year is 66,000. Divided by the current liabilities for that year, 75,000. Divided by 75,000. So you take 114,000 minus 66,000. Then you divide by 75,000. .6. We're done with that. We're done with that. But remember for the current ratio, is given by the current assets over current liabilities. So in this case, for 2015, we take the current assets, which is 138,000, we divide by 100, 800, we get the answer. For 2016, current assets were 114,000, divided by current liabilities 75,000, we get the answer like that. So in this current ratio, we don't subtract inventory. But for the quick ratio or asset effects ratio, we subtract inventory from the current assets before dividing with the current liabilities. Debt to equity ratio. What shall we do the debt to equity ratio? It is written there, the fixed return capital divided by equity. The fixed return capital divided by equity. If you are so careful about the financed by part, that is where we have the equity and the long-term liabilities. So under the financed by, the only fixed return capital that we have, it is the 10% debenture. Remember we said it is the debenture, the preference shares, the bond, the loan. The only thing we have there is the 10% debenture, 180,000 in the year 2015, 120,000 in the year 2016. That is the fixed return capital. Then we divide by the equity. Equity now is going to comprise of the others. Ordinary share capital, you add share premium, you add the revaluation reserve, you add the retained earnings. This is what an equity. So you take now 180,000 divided by the sum of all those. That is what it means. That is what it means. So debt equity ratio. The fixed return capital divided by equity. 2015, for 2015, the fixed return capital is only 180,000 for the debenture. You divide by equity. That year, equity comprises 60,000 for ordinary shares. Add the share premium, 16,800. You add the revaluation reserve, 24,000. You add the retained earnings, 30,000. That is for 2015. You get 130,800. So this one is going to be 180,000 divided by 130,800. This is 1.37. You do the same for the year 2016. You do the same for the year 2016. You do the same for the year 2016. This is the other ratio. You have done the debt to equity ratio. Then you are told the inventory turnover ratio, which we know is the cost of sales of average inventory. The cost of sales of average inventory. So you come here, the cost of sales, you get it from the income statement. So you are given here the cost of sales, 144,000 for the year 2015, 120,000 for the year 2016. That is the cost of sales. Then you divide by the average inventory. Average inventory. Average inventory. So here we are, for the year 2015, we are not given the opening inventory. We are not given the opening inventory. Actually, we are only given the inventory, and the inventory that appears in the statement of financial position is normally the closing. It is normally the closing. Are we given here anything? We are not given. So for the year 2015, you don't need to do the average inventory because you only have one inventory, which is this that you are given here, 78,000. But for the year 2016, we have got two inventories. Somebody might wonder, where do we get two inventories for the year 2016? For the year 2016, we have got two inventories. Why? Because the closing inventory for 2015, it is the opening inventory for the year 2016. So this inventory for 2015, it is the opening for 2016, and then the same 2016, we are given the closing. So 2016, we have both opening and closing. The closing for 2015 and the closing for 2016. The closing for 2015, it is the opening for 2016. That is what you need to argue. So for 2015, don't calculate the average. When the inventory is only one, use it as average the way it is. We only average when we have two, but when it is one, don't average. So you will take the cost of sales that year. So this is the inventory turnover. We have said it is cost of sales divided by the average inventory. Cost of sales divided by average inventory. So for the year 2015, we have picked the cost of sales to be 144,000 divided by the average inventory. That year we had only one inventory, 78,000. Do that, you get the cost of sales. But for the year 2016, this closing inventory for 2015 is the opening. Remember, it is a difference of one of some hours. When we close 2015, we close it maybe a time like now. But tomorrow in the morning, the business will open. So this inventory that we close with in the year 2015 is what we shall open with the following day in the morning. That is the new year. So that is why we normally say that. In the 2016, we are going to have the two inventory. So this one is going to be the cost of sales for 2016, which is 120,000, divided by the average of the two now. You get 78,000 plus 66,000 divided by 2, which is the same as what? So 2,000. So it is the same as 120,000 divided by 72,000. That is 1.67. The turnover ratios we said you put your answer as times, the number of times, the number of times. That is all. Then the next ratio is the trade receivables turnover. That is the same as the debtors turnover, which we said it is given by the credit sales divided by the average debtors. The average of the debtors turnover period, let me share it here. Debtors or the receivables turnover, not correction period, the turnover. The debtors or accounts receivable turnover, credit sales over average debtors. But I've told you, if the debtor is only given as one figure, you don't average. You don't average. You only average when you have two figures. So if you look at the question that we have here, the trade receivables for the year 2015 is only one figure, so we don't average. But for the year 2016, we shall have two of them. The closing for 2015 becomes the opening for 2016, so we average them. So 2016, we shall average the receivables, but 2015, it is only one figure. So how do you deal with it? You'll come here and say, the debtors turnover is given by the credit sales of average debtors. So we start with 2015. Remember, you get the sales from the income statement, and there you are told that sales are on credit. All the sales are on credit. You do to 40,000. Credit sales divided by average debtors. The debtors figure is 1 for the year 2015. You divide it by 78. So how many times are we correcting debtors? Or correcting money from the debtors to 40,000 divided by 78,000. 0.3. 240, not 24. 3.07. Any turnover ratio, you put it times. That is the number of times we are correcting money. from our debtors. 2016, check the sales for that year 2016. Here it is 240,000. Now you are going to divide by 78,000 plus the debtors or receivables for 2016. I think I made a mistake. Here it was 60,000. I used the figure for the inventory. 60,000. So this one is going to be 4 times. The receivables was 60. 78 was the inventory. So in this case, it is going to be 60,000 plus 48,000 divided by 2. I'm getting the average debtors. Yeah. And 8,000. That's 240,000 divided by 148,000. 2.22 times the number of times we are converting debtors into cash.
Malim, I think the 108 you should divide by 2.
Oh, I forgot. Sorry. Thank you for reminding me.
54.
Yes. 108 divided by 2. Oh, I forgot. Huh? Yeah. 4.44. Correct. Thank you for reminding me that. That is it about that. Average correction period. We said it is the opposite, the reciprocal of this. The formula for turnover is what you interchange. The numerator becomes the denominator. So the average. Correction period given by the average debtors on the credit sales times the days or weeks, whichever, or months. So for 2015, the average debtors we got was 60,000 divided by 240,000 interchange now. It was 240 over 60, now it becomes 60 over 240. But now this one you multiply by the days. If you look at the question, below the trial balance or the statement of financial position, we are told that assume a 365-day year. So you multiply here by 365. So you compute that as 60 divided by 240 times 365. You get an average of 91.25 days. Those are the number of days it takes us to collect money from our debtors. On average, it takes 91.25 days to collect money from the debtors. 2016, it was 240 over 54. This one now will be 54,000 divided by 240,000 times 365. It's 2.125 days. On average, those are the number of days we are taking to correct the receivables or to collect the money from the debtors. An average of that. The shorter, remember, the better. The shorter the period, the better. Rate of or return on capital employed. Return on capital employed. Let me share with you the formula, then we calculate. It was our first formula, the return on capital employed. We are told it is the net profit after tax. When you are not given tax, you just use the net profit for the year, divided by the capital employed. How do you get the capital employed? Total assets minus current assets. That is the most commonly used formula. Total assets minus current assets. So you need to get the capital employed for 2015, the capital employed for 2016. And then the figures you get, you shall divide the net profit by them. So that is how we do it. The net profit of a capital employed. So we are calculating rows. The net profit of a capital employed. Profitability ratios are normally expressed as a percentage. So 2015, the capital employed, the total assets. Just go there and get the figure for the total assets. They are indicated there. 2015, current assets and the non-current assets, they were totaling for 11,600. You minus the current liabilities for that year. Total assets minus current liabilities. Current liabilities for that year was 100,800. So that one will give you 411,600 minus 100, 600, 10,000. So the rows, the fund for capital employed for that year, we shall take the net profit from the income statement up there. The net profit for the year was 24,000. Divide by the capital employed, 10,000 times 100%. $7.74 for 2015. So 2016, capital employed, total assets for 2016 from the statement of financial position, 312,600 minus the current liabilities, 75,000. Will give you the capital employed first. Put that 7,600. So the rows, the return on capital employed will be the net profit 48,000 divided by 237,600 times 100%. Just a minute. Okay. So we do that. 48,000 divided by, so that's 7,600. So it is going to be 20.2. Like that. Lastly is the net profit margin. The net profit margin is simply the net profit divided sales. Sorry, net profit over sales. Net profit over sales. Net profit margin is 100% net profit over sales. So it is very simple. For this year, 2015, you take the net profit that was realized, is there, 24,000, divided by the sales for that year to 40,000 times 100%. For the year 2016, the net profit for that year was 48,000 divided by sales for that year was also to 40,000. Get that. So for the year 2015, it's going to be 24 divided by 40, which is going to be 10%. The other one is 48 divided by 40, 20%. So the only technicality with ratios is only to understand the formulas. The figures you will be provided with. So understand the formulas. The figures are going to be there in the statements. Then you are done. Then you are done. I want you to go to the past paper questions. We have more, including the third question that I have not attempted here. Using the same approach, try to solve them. So for today, I want us to stop there unless somebody has a question. If there is no question, enjoy your evenings.